NFOs are very inviting. The ads are all around you. The promise of the returns is right there. And any which ways, every retail investor has now become a participant in the equity markets in one way or the other. So we thought it's a good time to try and talk about, quote unquote, the NFO season. One or two NFOs ongoing right now. Some have happened in the past. A lot have happened in the last 12 months. And Mohit Gang is just the perfect guest to have on a show like this to try and understand about what's the view on the current ones, as well as because some people believe that NFOs may not be the best to put in immediately at the start, but maybe after some bit of time, we'll try and ask him if he's got some favorable view on the NFOs that have come out in the last 12 months as well. Hopefully in the show, a bit later on, we'll also get in Nisreen, Mamaji, time permitting. But Mohit, great having you. Thanks for taking the time out.
Thank you. As always, pleasure is all mine, Neeraj.
Thank you so much. So, Mohit, right up your alley. And I know everything investing is up your alley, but this one in particular, I thought it'll be great to get your view here. Um, everybody's talking about yields in the US as well, and have they peaked, at what time they'll peak, and is there a way for Indian investors to make advantage of that? So Aditya Birla Sun Life, the two new fund offers, US Treasury 1 to 3 year bond yield ETF fund of fund, and the 3 to 10 year bond yield ETF fund of fund. Can you explain to our viewers what are these products, if you've studied them, and what kind of investors are they suitable for, if at all?
Sure. Neeraj, so I'll go with the Aditya Birla Treasury Fund first, the US Treasury Fund first. Look, it's a very, very unique idea. It's especially meant for very sophisticated, savvy clientele who understand not just the debt market, not just the bonds and the yields, but they also understand the US bond markets. They've been studying the US bonds. They've been watching the US Treasury yields, so on and so forth, right? So it's not for everyone. First and foremost, it's for a very, very particular segment who wants a fixed income allocation in the highest possible safety asset available globally, right? And why I say that, because the underlying holdings of the fund will be US Treasury investments, US Treasury bonds, and US Treasury, as all of us know, is considered the safest instrument globally, been rated AAA globally. They've got downgraded by a couple of agencies of late and now are AA plus, but still US has never defaulted on its bonds. Right? So if you want one safest parking instrument for your money, I think that's there. But the whole idea out here is a play on three parts. One is obviously the static yield of the bond. The US Treasury is since 2007 at its highest level. The 10-year Treasury yields are at around 4.8, 4.83 as I'm talking to you, right? Which is one of the highest we have seen in the last 15 years or 17 years, maybe. Second, so your static yield is fairly high. The static yield on the 3 to 10-year portfolio, which Birla is quoting right now, is somewhere in the range of around the same range, 4.8 to 5%, right? The second is the game of capital appreciation. Now, all of us are anticipating that the rate cuts will start happening fairly soon. Whether it happens this financial year in US or it spills over to the next financial year, but in next 3 years, Neeraj, the rate cycle will reverse full swing, right? And there are early signs of it. The Fed is going a little dovish in its commentary of late, and perhaps maybe one more rate hike. But if not, then yes, you can anticipate a rate reduction cycle happening from next year, which will mean a whole lot of capital appreciation. 100 bips reduction on a 10-year treasury paper with a mod duration of around 6%, 6 years could mean almost like a 6 to 7 year kind of a capital appreciation on the portfolio over and above the YTM. So that's the second play, which is the capital appreciation over a course of next 3 years. And the last play is the currency play. Now, historically, for last 20, 25 years, INR has depreciated almost 3 to 3.5% year on year against the US currency. If that continues to happen for next 3, 5 years, you can very well add that additional 3 to 3.5% over and above the returns which you will make from the YTMs and the capital appreciation. So put in all together, yes, it looks fairly attractive. Yet it's a fixed income allocation for very, very savvy clientele and highly sophisticated clients. But the risks are also threefold. If the rate cycle doesn't reverse, if the yields go up further, if the currency doesn't, the US dollar doesn't appreciate that much, I think those risks have to be accounted for. So the risks are equally high on this.
Right. Mohit, thanks for that comprehensive answer. Nisreen Mamaji is also with us. Nisreen, thanks for joining in. Do you have any strong views, either direction, on this latest offering from the Aditya Birla stable, which, according to Mohit, of course, and maybe rightly so, is for sophisticated investors who understand debt, understand global debt, and maybe have some exposure to the global markets per se?
Sure. So, typically investing in any new fund offer will, involve understanding your own financial goals, your risk tolerance, and the market conditions. Now, having said that, there are two bonds which are available right now. There's one in the 1 to 3 year segment and one in the 3 to 10 year segment. So basically, the investor will need to know what is their tenure that they are investing in, whether it is in the 1 to 3 year bucket or in the 3 to 10 year, as well as their risk appetite for either of these. Now, typically what we feel right now is that the US federal interest rates are at a multi-decade high. So, and there is an expectation of rate cuts in the near future. So this could present an opportunity to the investor to lock in at a higher rate and, take advantage of the capital gains possibility. Also, it's a hedge against the INR depreciation. So if you feel that the rupee is going to go in the direction that you are hesitating to take that risk, then yes, you can invest in the US Treasury bond. Also, if you want to park your money internationally, the LRS route has a certain limit. Also, the TCS now, the tax collected at source is 20%. So in this kind of a product, there is no capping of the amount, as well as there will be no TCS applicability. So for those reasons, you can consider this particular investment. As Mohit has already said earlier, it is for a sophisticated investor. Now, having said that, there are a few cons also. So the market risk will still be there. You could be subject to interest rate risk, to inflation risk, and general market fluctuations. Also, it exposes the investor to the currency risk if it goes the other way around, not as per your expectations. And also, if the interest rates move differently, then you would be seeing a lower return because there is an inverse proportion relationship between the yield and the coupon rate. Also, there is not much track record of this kind of a fund. So therefore, we don't really have a precedent for judgment. So, I've given you a few pros and a few cons, and I think we should make a very a judgment which will look at both the pros and the cons and whether you yourself are a sophisticated investor with either of these tenure buckets.
Okay. Just before we move on to the next topic, though, Mohit. So therefore, let's assume, Mohit, that as Nisreen said, that and you summed it up as well. So you all the points. I'm just trying to get to that a point that let's assume that the investor who's listening to us, she is a sophisticated investor. She is open to taking the risk of interest rates because you could that is probably the moving part. Otherwise, history shows us that the INR has depreciated and likely that continues. Rates are at highs at some point of time. They will come off. So let's assume the investor has taken all of these into account and she's looking to you for guidance. Would you, if you were such an investor, Mohit, put in money to work in this NFO?
Neeraj, I think just 2 points to consider out here. In case the investor is wanting to invest internationally, which is wanting to have a US dollar denominated asset, which is extremely safe. And as Nisreen rightly said, it doesn't use your LRS pool. So you send it in rupee, you invest in rupees, and you redeem in rupees. So obviously your LRS pool is not touched. So if you want to develop that kind of a corpus, which is a safe corpus for any of your financial goals, which could be your child's education or something, right? So then I think this merits extreme amount of attention. And secondly, your return expectations have to be fairly tepid with this, right? So you can't really expect double-digit returns from this kind of a product. Your return expectation has to go between 4 to 8%. If you're really lucky, you might just end up on the higher band of this range or maybe a little higher if all three factors, which is the currency and the rate cut and the yields, all three work for you. But otherwise, I think that should be the range. If an Indian investor is okay with that and it fits into his goals, then yes, by all means.
Okay. Thanks for that, both of you. We have short on time, so I'll move on quickly to the other topics as well. Nisreen, I'll start with you. The MF Mutual Fund NFO, the first new fund offer of the Helios Group, the Helios Flexi Cap Fund, is about to start come Monday. Now, question is, one, should people look at Flexi Cap as a category? If yes, should people look at Helios for the Flexi Cap as a category, part one? Or should some choose other fund house? Why or why not?
Okay, sure. So, Flexi Cap as a category is one of my favorite, categories as regulated by SEBI, because all that it requires is to have 65% of a scheme's total assets in equity. So there is no cap as per the, that you have to be like in a multi-cap, there would be a certain amount which has to be in a large cap, a mid cap, or a small cap. In a flexi cap fund, the fund manager has the ability to choose, irrespective of the market cap. So therefore, what happens is that there is a large stock of companies which he can choose from with a range of capitalization without having a set percentage allocated to any particular large cap, mid cap, or or small cap. Also, it could be interesting to investors because typically a flexi cap will have a large cap bias, and the tactical allocation will be in a mid or a small cap category, which is the situation right now with all the other flexi caps which are available in the market. So therefore, a large, mid-size, small size, any company can be part of a flexi cap fund, keeping in mind the mandate of the fund and the fund manager's call. And secondly, also because the time horizon that an investor should be looking at for a flexi cap fund is typically between 5 to 7 years. That much time you must give the fund to perform and for you to meet your goals. Shorter time frame than that will not be adequate for you to be investing in a flexi cap category. Now, if you're asking me specifically about Helios, basically it is started by Samir Arora and Dinsha Irani, who are both ex-Alliance. And they have a philosophy which is based on 8 parameters on which they follow the EI technique, which is the elimination technique. So it's not what you add but what you eliminate from the entire universe, which could be Nifty 500, for example. So they have 8 parameters on which they are eliminating stocks. And the reason why they have actually come up with the flexi cap fund is because the NSE 500 has returned up to date this financial about 12 to 13%. Last year it was only 4.4%. So they feel in 20 to 21 months, it's a normalized number. And if you convert it to also rupee depreciated, in dollar terms, it's about 10%. So in dollar terms, a foreign investor has made about 5 to 6% in 21 months. So they also feel, as far as the investors concerned, when we are looking at the rupee terms appreciation or the dollar terms appreciation, they feel this is a good offering. Also because 50% they are probably going to have it in large caps and the balance 50 in maybe mid and small. So that is the reason that they have also selected the flexi cap as one of their first offerings to our mutual fund industry in India.
Do you recommend that? Or
flexi
is there a
cap
better
I
fund?
will recommend, but typically we stay away from investing in a completely new fund house unless we have a track record, to show our investors.
Okay.
So I will be very honest and say I will not be recommending Helios Fund House, the offering of the flexi cap, but flexi cap as a strategy, we have offered it to a lot of our investors. We're very happy with the results. Even somebody who has a moderate, risk profile, it has been, very happy because if they don't want to be in 100% large cap, through the years, we have sort of graduated from 100% large cap to maybe a flexi cap or a large and mid category. And we have obviously seen very, superior customer experiences in that.
Got it. Mohit, what is your view? The same set of questions to you.
Neeraj, so look, I didn't I didn't get your question about Helios Capital. Only thing I know is Samir, right? And that's what is being spoken about, and that's what is perhaps creating some amount of waves, if at all it is creating, right? And honestly, it's all about the person out there, the person at the helm. Finally, as mutual fund advisors also, we typically go and give an extreme amount of weightage to the fund manager, his capabilities, his managerial abilities, his track record, his past history, so on and so forth, right? So, and out here, we have impeccable record from the gentleman out there. He's in fact the longest serving fund manager in, if you take Indian mutual fund industry, the oldest and the longest. Right, and that's a very big track record to have. When he was with Alliance along with Nisreen Irani, they were consistently rated the best fund house for consecutive 3 or 4 years, if I'm not wrong. right? And even the PMS and the AIF track record of Helios, which they run currently in India, they have almost 1,800 crores of assets out there. It's again a fantastic track record, right? So on the track record side, I think they have an established pedigree. Globally, they are a known name. They operate out of Singapore for the bulk of the offshore clients and even long funds and hedge funds and so on and so forth. But my whole thing is, look, I think the great part about this entire setup is the research will be common, whether it's the Singapore desk, whether it's the India desk, whether it's the PMS desk or their AIF desk, the research plate is common. They will adopt and change depending on the client profile. Yes, of course, they will not be as aggressive as they could be perhaps in a PMS or an AIF, but they will still adopt the same research, the same methodology across uniformly. So my sense is, I think, given the pedigree of fund manager, which is Mr. Samir Arora himself, I think it merits attention. However, as Nisreen rightly said, we are also not the ones who kind of go ahead and advise on NFOs. But this is something we will keeping a very close eye on. And honestly, if someone is really impressed with Samir Arora's track record, I don't think so. It's that short a case, right? One can perhaps look at it with an open mind if really wants to invest. But I think within 6 months to a year, if they really show some performance, this will definitely deserve some attention.
Got it. Well, thank you for some candid feedback on both the NFOs, and they are maybe for different kinds of investors. But I'm certain that this interview and your comments, both of you, will really help our viewers and the readers who will read about this over the course of the weekend. Nisreen, Mohit, thanks for taking the time out and being with us on the Mutual Fund Show.
Thank you.
Thank you so much for having us.
And the pleasure was ours, and viewers, thanks for tuning in.